One of Britain's biggest housebuilders just said something quietly devastating. Not in a press conference. Not on the evening news. In a trading update most people scrolled right past. And what they said? It changes everything we thought about 2026. Let me show you what they're seeing that we're not. Right? Let's get into it. House prices didn't crash this week. Sales didn't suddenly stop. Estate agents didn't board up their windows. None of that happened. But here's what did happen. Persimmon, and if you don't know them, they're absolutely massive, quietly released a trading update. This is a company that completed nearly 12,000 homes last year. 12,000. That's not some small regional builder. That's one of the giants. And in that update, they said something that should have made front-page news. They're not expecting any material improvement in market conditions in 2026. Let that sink in for a second. Not, we're cautious. Not, we're monitoring the situation. No. They're straight up saying, don't expect things to get better next year. Now, on paper? That sounds like boring corporate speak. Standard cautious language from a FTSE company. But if you actually understand what builders see, this is a massive warning sign. Because builders don't guess. They don't speculate. They sit at the absolute center of the housing machine. They see reservation rates in real time. They see cancellation rates. They see which buyers are still showing up, and which buyers have quietly disappeared. When a builder of this size says, don't expect improvement, they're not being pessimistic for the sake of it. They're telling you what the data already shows them. But here's the thing that really got me. This isn't a company announcing collapse. Far from it. So what's actually going on? Here's where it gets interesting. Persimmon completed 11,905 homes in 2025. That's up 12% on the year before. They described their order book as robust. So they're still building. Still selling. Still functioning. But they're also saying, the wider market isn't getting easier. And that combination? Delivery continuing while conditions stay difficult? That's the uncomfortable middle ground most people don't understand. It's not a crash. It's not a boom. It's a grind. A slow, exhausting, uncertain grind. And that's actually harder to navigate than a clean collapse. Because in a crash, at least you know where you stand. Prices fall. You wait. You buy cheaper. Done. But in a grind? Everything just feels stuck. Buyers hesitate. Sellers hold firm. Transactions slow. And nobody knows when it ends. That kind of message matters because builders sit right at the center of the housing machine. They see reservation rates. They see cancellations. They see which buyers are still active. And which buyers have quietly disappeared. And in this update, Persimmon points to a change in the mix of demand. Not a dramatic crash. A quiet shift. A shift that most commentators completely missed. And here's the bit most people completely missed in that update. Honestly, it's the part that worries me most. Right? So Persimmon is warning about 2026. That alone should have your attention. But there's something else in that trading update. Something buried in the language that most commentators skipped right over. And it's about who's actually buying homes right now. See, when you think about house buyers, you probably picture a young couple saving for years. First-time buyers stretching for a deposit. A family upsizing because another kid's on the way. Normal households. Retail buyers, as the industry calls them. But here's what most people don't realize. The UK housing market doesn't just run on retail buyers. It runs on something else too. Something much bigger. Much quieter. And much more important than you'd think. Bulk buyers. And Persimmon just told us those bulk buyers are stepping back. Let me explain what bulk buyers actually are. Because this is crucial. A bulk sale is when a builder sells a large number of homes in one go. Not one house to one family. Dozens. Sometimes hundreds. To a single buyer. Who are these buyers? Usually institutions. Big investment funds. Build-to-rent operators. Housing associations, what the industry calls registered providers. These aren't normal buyers. They operate completely differently. They have massive capital. They can move quickly. They don't need mortgages. They don't get nervous about interest rates. They just buy. And here's why that matters. When the retail market slows down. When ordinary households start hesitating. When mortgage rates make people think twice. Bulk buyers keep the system flowing. They act like a shock absorber. A safety net. A floor under the market. Builders know this. They rely on it. When retail sales get tough, they can shift stock through bulk deals. Keep the revenue coming. Keep the sites moving. Keep the whole machine running. But Persimmon just said something uncomfortable. Bulk sales in their order book are fewer. Build-to-rent demand softened in the fourth quarter. In plain English? The shock absorber is weakening. The safety net has holes in it. The buyers who were supposed to pick up the slack. They're not picking up as much as they used to. And when that happens, builders get pushed back toward the hardest part of the market, selling one home at a time, to individual households, who are already stretched, already nervous, already doing their heads in over mortgage calculations. That's a much harder game. Much slower. Much more uncertain. Now you might be thinking, wait, aren't interest rates coming down? Isn't that supposed to fix everything? Well, here's where it gets complicated. Right? Let's talk about rates. Because this is where a lot of people get confused. Yes, the Bank of England cut the bank rate in December 2025. Down to 3.75%. And the vote was tight, 5-4. That matters. It signals the start of easing. The direction is down. Good news, right? Relief is coming. Happy days. Not so fast. Because here's the thing about rates. Direction and level are two completely different things. Rates can be falling. And affordability can still be brutal. It's like saying the temperature dropped from 40 degrees to 38. Yeah, technically cooler. But you're still absolutely roasting, mate. That's where we are right now. The mortgage market isn't comparing today to last month. It's comparing today to a few years ago. When money was cheap. When you could fix it under 2%. When borrowing felt almost free. Those days are gone. Properly gone. And even with rates coming down slightly. For millions of households, the affordability ceiling is still very real. Very tight. Very uncomfortable. Very much doing their heads in. Let me show you what the actual data says. Because this isn't speculation. The Bank of England's Money and Credit Release, proper official data, showed net mortgage approvals for house purchase edging down to 64,500 in November. At the same time, remortgaging approvals were rising. Now, those might sound like boring numbers. But think about what they actually mean. Fewer new buyers are coming into the market, while more existing borrowers are actively dealing with refinancing. That's a market where people are still managing payment pressure, still firefighting their monthly costs, still trying to figure out how to make the numbers work, even while headlines say rates are easing. And here's the psychological bit. When households are busy managing payments, when they're focused on surviving their current mortgage, when every spare pound is going toward keeping the roof over their heads, they don't rush into bigger commitments. They don't think about moving. They don't browse Rightmove dreaming of a bigger place. They delay. They hesitate. They stay put. And when they do finally look at buying, they negotiate harder. They lowball offers. They walk away more often. That's the psychological shift builders notice first. Not a dramatic collapse. Just a change in how people behave. More caution. More suspicion. More let me think about it. And that tends to show up in builder data long before the wider public realizes anything has changed. But there's another layer to this story. And it involves a part of the housing system most people have never even heard of. Right? Let me tell you about registered providers. Because Persimmon mentioned them too. And what they said is quietly concerning. Registered providers is the industry term for housing associations and similar bodies. These are organizations that provide affordable housing, social housing, shared ownership, that sort of thing. They're a crucial part of the system. When builders have stock they need to move, sometimes they sell to registered providers. It's a pathway for homes to flow into the affordable housing system. Good for the builder, they shift units. Good for the provider, they house people who need it. Good for the system, homes get occupied. But Persimmon referenced continued challenges in the registered provider market. What does that mean? It means these organizations are under pressure. Funding pressure. Cost pressure. Budget constraints. If their costs rise faster than their income. If government funding doesn't keep pace. If interest on their own borrowing becomes more expensive. They can't take on as many homes. They pull back. They say, not this quarter, maybe next year. And that's another friction point. Another part of the demand chain that's slowing down. Another buyer that's not buying as much as they used to. Now, on its own, that's not a crisis. Registered providers aren't going to collapse overnight. But add it to everything else we've talked about. Retail buyers stretched. Bulk buyers cautious. Build-to-rent softening. Registered providers constrained. And suddenly you've got friction in multiple parts of the demand chain. Not one big crisis. Lots of little pressure points. All adding up. All making the system slower. Stickier. Harder to move. So what do builders do when the market gets sticky? They can't just sit there waiting for conditions to improve. They've got shareholders. Targets. Land costs. Staff to pay. They need to keep selling. But they also can't slash headline prices. Not aggressively anyway. Because that creates its own problems. It spooks the market. makes existing buyers feel like they overpaid, creates negative headlines, undermines confidence further. So instead, they get creative. And this is where you start seeing incentives. We'll pay your stamp duty. Here's a £10,000 deposit contribution. Free upgrades to your kitchen. Carpets and flooring included. Maybe they'll throw in the garden landscaping. Maybe they'll cover your legal fees. Maybe they'll offer a furniture package. All of this is effectively a price cut, just hidden, disguised, presented as a bonus rather than a discount. These incentives aren't new. Builders have always offered them. But the scale? The frequency? The sheer creativity? That's what changes when the market tightens. And if you've been to a new build site recently, you've probably seen exactly what I'm talking about. It's everywhere now. When buyers are hesitating, when reservations are slow, when sales targets are at risk, builders lean harder on incentives. They have to. It's the only way to keep stock moving without openly cutting prices. And here's the thing. If you're buying right now, this is actually good news for you. You've got leverage. You've got options. You can negotiate. You can ask for more. You can push for that extra contribution. Builders would rather give you £15,000 in incentives than drop their asking price by £15,000. Because the asking price stays high. Their reported average selling price stays high. Their shareholders stay happy. Everyone pretends the market is fine. But underneath? Real prices, what people actually pay after incentives, are softer than the headlines suggest. This is the hidden discounting that doesn't show up in official statistics. Not immediately anyway. It shows up later. When surveyors start valuing homes. When remortgage valuations come in. When people realize their home isn't worth what they thought. That's the delayed reality check. And it catches a lot of people off guard. Right? Let's zoom out for a second. Because Persimmon isn't operating in isolation. They are part of a much bigger picture. What does that wider picture look like? The Office for National Statistics reported UK house prices were still up year-on-year. Around 1.7% to October 2025, on a provisional basis. Meanwhile, rents remained elevated. Varying by region, but generally still high. Still painful for tenants. Still eating into savings. So this isn't a simple story. It's not prices crashed, crisis over. It's not everything's fine, keep buying. It's somewhere in between. Somewhere uncomfortable. Somewhere that doesn't fit neat headlines. Prices holding up on paper, while affordability, monthly payments, and rent burdens keep tightening underneath. That's the squeeze. The pressure. The thing that grinds people down slowly. And when that happens, the market doesn't always crash loudly. Sometimes it just stops behaving normally. Let me show you what not behaving normally actually looks like. Because this is where it starts getting properly concerning. What does an abnormal market look like? It looks like homes taking longer to sell. Weeks turning into months. Price reductions stacking up. It looks like transactions slowing. Chains collapsing. Sales falling through. It looks like people staying put. Not because they are happy. Because they can't afford to move. Because the maths doesn't work. Because they are stuck. And it looks like builders throttling supply. Slowing down construction. Controlling the pace of building to match weaker demand. That last bit is important. Because recent construction PMI data described a long downturn. House building particularly weak. Consistent with developers actively controlling how much they build. This isn't panic. It's calculation. If demand is soft, you don't flood the market with new homes. You build less. You wait. You protect your margins. That's a controlled response to a market that isn't clearing naturally. And here's the irony. By building less, builders might actually support prices in some areas. Less supply means less downward pressure. But it also means fewer new homes getting built. Fewer construction jobs. Fewer completions for people who desperately need somewhere to live. The housing shortage doesn't get solved. It just gets worse. Quietly. While everyone focuses on prices. So we've talked about rates. We've talked about bulk buyers. We've talked about affordability. We've talked about incentives. But there's one thing that ties all of this together. One thing that matters more than any single data point. Confidence. Because housing markets don't just run on money. They run on belief. Belief that prices will hold. Belief that your job is secure. Belief that the future will be okay. Belief that buying now is better than waiting. When that belief is strong, people stretch for deposits. They take on big mortgages. They commit to 25-year debts without blinking. But when that belief wobbles, everything changes. People hesitate. They second guess. They wait for more clarity. They stay in rentals longer. They keep refreshing Rightmove without actually doing anything. And here's the brutal truth about confidence. Once it's gone, it's incredibly hard to get back. Confidence isn't like interest rates. You can't just cut it or raise it with a committee vote. Confidence builds slowly, through months and years of stability, through positive experiences, through seeing friends and family buy successfully. But it can shatter fast. One bad headline, one friend who got burnt, one story about negative equity, and suddenly everyone's nervous. That's the environment we're in right now. Not full-blown panic, but not confidence either. Something in between. Cautious, uncertain, wait and see. So what does all this actually mean? Depends on who you are. If you're a first-time buyer, this is a strange moment. On one hand, you've got leverage. Builders are offering incentives. Sellers are more negotiable. Competition is lower. On the other hand, affordability is still brutal. Rates are still high compared to a few years ago. And nobody knows if waiting would get you a better deal. It's a gamble either way. No easy answers. If you're looking to sell, this is a reality check moment. The price you have in your head? From that valuation 2 years ago? Or what your neighbor sold for in 2021? That might not be the price you get today. Doesn't mean you can't sell. Homes are still selling. But expectations need adjusting. And patience is required. If you're a landlord, especially a leveraged one, this is a pressure test. Higher mortgage costs. Potential rent controls being discussed. Tax changes already biting. Some landlords are holding. Some are selling. Some are proper stuck, can't sell for what they need, can't afford to keep holding. It's an absolute grind for a lot of people. Now, I need to say something important here. Everything we've discussed so far is national level. Averages. Aggregates. The big picture. But the UK isn't one housing market. It never has been. What's happening in London is different from Manchester. Bristol is different from Birmingham. Edinburgh is different from Cardiff. And within those cities, different postcodes, different stories, different realities. Some areas are still seeing competition. Multiple offers. Quick sales. Prices holding firm. Other areas? Absolute ghost towns. Listings sitting for months. Price reductions everywhere. The national data smooths all of this out. Gives you an average that might not reflect your reality at all. The South East and London have been under particular pressure. Affordability there was already stretched to breaking point. Price-to-earnings ratios that make absolutely no mathematical sense. When rates rose, those areas felt it first. And hardest. Some northern and Midlands areas have shown more resilience. Lower price points. Better affordability. Different buyer demographics. But even there, it's not simple. Local employment matters. Local wages matter. Local confidence matters. So let me give you my honest take on all of this. No hype. No doom. Just what I actually think is happening. Here's my honest read of the situation. This isn't a crash. The word crash implies sudden, dramatic, obvious. This is a grind. Slow. Uncomfortable. Persistent. Markets can grind for years without crashing. Prices can stay flat while affordability stays brutal. Transactions can stay low while headlines stay calm. That's the weird middle ground we're in. So what about 2026? First, rates are likely to keep coming down. Gradually. Slowly. The Bank of England will probably cut a few more times. That's good. But it's not a magic fix. Even if bank rate falls to 3.5%, or 3.25%, mortgage rates will still be way higher than people got used to. The era of 2% fixes isn't coming back. Not anytime soon. Maybe not ever. Second, affordability will remain the binding constraint. Not prices. Affordability. It doesn't matter if house prices stay flat. If wages don't rise fast enough to match monthly payments, people still can't buy. Third, builders will stay cautious. Persimmon isn't going to suddenly ramp up construction because rates fell a quarter point. They'll wait for actual improvement in demand. Actual improvement in conversion rates. Actual improvement in confidence. Until then, they'll control the pace. Build to demand. Not ahead of it. Right? Let's bring this all together. Persimmon, one of Britain's biggest housebuilders, has warned they're not expecting any material improvement in market conditions in 2026. They're still building. Still selling. Still delivering. But they're not seeing the market get easier. Bulk sales are fewer. Build-to-rent demand softened. Registered providers face continued challenges. Meanwhile, retail buyers remain stretched. Affordability is still tight. Confidence is still fragile. Rates are coming down. But slowly. And not enough to transform affordability overnight. Construction is weak. Builders are controlling pace. Supply isn't flooding in. And the market? The market is grinding. Not crashing. Not booming. just stuck in that uncomfortable middle. This isn't a panic story. It's a pressure story. A story about a market that works on paper, but struggles underneath, where the headlines say one thing, and the reality feels different. That's the UK housing market in early 2026. And that's the signal Persimmon is sending. If you're watching from the UK, I'd genuinely love to know what you're seeing. Is your local market holding? Or are homes sitting longer? Are you seeing new build incentives becoming normal? Are buyers hesitating more than a year ago? Are sellers getting realistic? Drop a comment. Tell me your town. Tell me what's actually happening on the ground. If you want more of this kind of breakdown, calm, evidence-based, no hype, no doom, just the actual data and what it means, then subscribe. Hit the notification bell. Stick around. Because this story is far from over. 2026 is going to be interesting. Rate decisions, policy shifts, builder strategies, market psychology, all of it evolving, all of it mattering. And I'll be here, breaking it down, making sense of the noise, telling you what actually matters. This isn't the end of the UK housing story, but it might be the moment people finally realize the market has already changed. See you in the next one.